Today I'm going to cover a fantastic topic in my view and look at something which is very important, and that's funding property deals in the UK market. Now, whether you're a seasoned investor or just starting out, this video is going to help you navigate the complex world of property investing, and you'll learn at least one new or different thing, and let me know if you don't, and I'll have to find something else which you can learn, but I'm sure you'll find at least one thing that piques your interest and is of use to you, so it's worth watching the entire video. Number one, understand your property investment strategy. So first things first, strategy is important. So before seeking funding, define your property goals and objectives and your overall strategy. Are you looking at buy-to-let residential properties? Are you looking to flip? Are you looking to build new houses? Are you looking to do commercial conversions? Are you looking at service accommodations? Are you looking at deal sourcing? Are you looking at being an agent? So all of those things you need to look at, including your location and what funding you have available and what experience you have and who is going to be working with you to help you implement the particular strategy. Number two, build a solid property business plan. Yes, it might sound boring and mind-numbing, but it's very important. Having a rock solid plan gives you direction and shows people what you're looking to do and shows that you're serious. So in your business plan, you can list out obviously all your aims, objectives, goals, do a SWOT analysis, strengths, weaknesses, opportunities, threats, a executive summary and everything else that goes in a particular business plan, including your KPIs and the margins and what you're looking to achieve and your USP in terms of what makes you different. A business plan is good if you stick to it and you look at it on a regular basis and you revise it and you follow it. If you're going to create it, print it and file it somewhere safe, I'll say don't bother, because you're wasting your time unless it's specifically for funding purposes, but then you'll be shortchanging yourself, because business plans aren't just for funding, they are for helping you expand your business. Now let's explore how you can finance your property deals. Property investors and crowdfunding can be two great options and opportunities in my view. Now, if you have access to a high net worth individual or individuals who you know are interested in property but don't have time to invest in property, and they want an equity stake, for example, in exchange for their investment, then you can obviously use your expertise, use their money, and that's going to be a hand in glove fit, okay, to do that. If you don't want to give equity, then you can obviously do it on an interest basis, but some people may not want interest and they want capital, in which case you can look at crowdfunding platforms and seek contributions from multiple investors using that particular platform to give you the cash that you need. Yes, it's not as cheap as going to a high street bank, but if a high street bank is able to give you money, then that's where you would always start, but their criteria is more stringent and strict, and it doesn't obviously cater for everybody. Now, when it comes to traditional lenders, obviously they have specific criteria. They look at your credit worthiness, your debt levels, your gearing, property valuations, your experience, and many other things, including your credit score. And if your credit score isn't right, or you don't have the right experience, okay, or the debt leverage isn't right, or there's other things that don't add up, or the margins don't quite work, then it's not going to work for you. So having all of those things in place and ticking every single box gets you the best rate, but that isn't always possible because we have different situations and circumstances for every different individual, so you might not quite fit, therefore you have to go to a second tier lender or to other lenders who might be able to assist you. A small self-administered pension scheme is an excellent option, and it's something that I think you ought to look at. I can't give you investment advice, so speak to an IFA or somebody who can offer you investment advice to look at how you can do that. But in very simple terms, a SAS is a trust, and if you're making profit, you can transfer some of your profits into a SAS. At the moment it's £6,000 every single year. If you qualify for making pension contribution in the last 3 years, then you can carry those forward. If you haven't made the contributions, that gives you a further £40,000 to carry forward and utilize. And then if you have a life partner or somebody else, then they've got their obviously annual allowances. There used to be a lifetime limit. There's no lifetime limit now, so you can grow it beyond what I think is 1.08 million from memory, but now you can grow it beyond that and there's no additional tax charge, so it works really well. And then if you once you've got money in a SAS, if you wanted to loan back some of that to the sponsoring company, i.e. your limited company, along with the company can offer some kind of collateral, up to 50% can be loaned back, and then you can use those funds to invest in residential property, but a SAS cannot invest in residential property, so that's going to limit you. But if you buy commercial property and you give it on a lease, for example, or if you use it as your own office and you're paying rent, any rent that goes into a SAS, no tax to pay. If a SAS sells a commercial property, no tax to pay. Because it's a trust, like I've covered earlier, it's going to be very tax efficient for inheritance tax purposes. If you've done a loan back and then you're paying interest to the SAS, your limited company or sponsoring company claims tax relief on the interest payments. The interest goes into a SAS, no tax on the interest received. So very quickly there and very briefly, you can see there are quite a few advantages, but talk to an IFA who can talk to you more about investment advice and whether that works for you or not. I've just kind of shared some of the benefits for you, and of course, just very importantly, any contributions you make into a SAS within your annual allowance or your carried forward allowance is all tax deductible as long as the money is paid into the SAS. So think about that carefully, and it's worth exploring.